Welcome to Barry Charles, your one-stop shop for everything finance. And today we are talking about PGG Wrightson. Yes, the company in New Zealand that is absolutely taking the world by storm. No, it's not, but it's paying a dividend, and sweet dividend that for the owners of the company. We're going to take a stock analysis of this company, look at the possible intrinsic value. If you stay around to the end, you'll find out a bit of a calculation around that. And we're going to give you all the key metrics to the stock so you can make an understanding if PGG Wrightson is right for you. Let's get to it here at Barry Charles. Remember to like and subscribe if you like the channel. Let's get to it. Yes, PGG Wrightson. Yes, great company, has done well, but it has looked not so great at times of late. Let's have a look at it. The revenue. So the revenue right here, right now, from its last year ending 975 million, which is only up 2% from last year. So very, very mediocre returns if you are an investor in this company, and that's why the stock went into the toilet just recently, dropping big time to this lowest lows in 52 weeks. There's two reasons for it. People seem to, especially in New Zealand, sell out of the company once the dividend date is there. They sell out quickly. I don't know why they do it, but it just seems to be constant, just flipping around, because obviously they're probably putting it into this company, into other companies to get the dividend all the time. I think this is basically what these people are doing, because there's not a lot of growth in New Zealand at this stage. There was growth in New Zealand in the past, but it's been pretty mediocre lately. But what's even worse, net profit 17.5 million, down 28% from last year. Wow, wow, wow. That's why the stock has gone down that much. That's why everyone's selling the boat. But does that mean you should jump on the boat? Well, keep watching to find out. Earnings per share is at 0.23, which is not bad for the company. P ratio 14.87. Do they deserve to be that rich? They're not really that growing that much, and they really need to work on growing if you want to get that sort of ratio. The dividend yield, well, it's a bit all over the show. All different metrics are saying different things, but I'm going to say it's around 6% yield at the moment. And they just about to pay a dividend of 10 cents, and that's 22 cents for the year. So pretty good if you got it at decent prices, around the $4 mark. So definitely a stock that's a dividend payer, and helps you as an investor. But in terms of growth, there's a lot of work to do. Let's have a look at the free cash flow here. Let's see. Free cash flow is at 6.8 million. So that's pretty good for a company this small. Not much to do acquisitions though. We'll need more money than that to do an acquisition, but definitely free cash flow is not an issue. But the big issue, this is the big issue, and this is the one that really does irk this company. 158 million long-term debt. You kidding me? And I have to be clear, I surrender. I am an owner of this business, and that is one thing I do not like at all. So if the world comes down on them, the stock is clearly going to need a miracle to stay alive. So they're going to have to improve their net profits. The revenue is there, obviously, but they're going to have to find a way to start paying this long-term debt down, because that is big losses for them as a company, and they need to figure out a way to pay that off. So that's something they're going to have to work on. Absolute disgrace. And if I got that figure wrong, I'm sorry, but yep, that's absolutely something they're going to work at. They're going to have to work on it. It could be 15.8 million, so don't get me wrong. Either way, it's not good. Obviously, 158 million is a lot worse. But yeah, if it's 15.8, it's still bad. So still something they're going to have to work on to get their total debt down. Looking at shares outstanding, 75 million. What I found out here is that 60% are held by the insiders. Minuscule by institutions, only 1%. So this is a stock that really some work to do if you really want to see profit. So obviously, looking forward for PGG Wrightson, what they need to do, they need to really work on getting some more improvement in their business. They're going to get their revenue starting to really creep back up. They're going to get their net profit back in the because really it's a struggling net profit compared to the revenue, so that's very down. So they really need to work on improving their top line and the bottom line. Often they get a lot of money to the shareholders, so that's something else that is not going to help this company going forward if they continue to. Clearly, they got to get rid of the debt. They got to cut down the debt. That's the big thing they got to do. Really got to cut down their debt big time. Get themselves into a better space there. They got to cut down their dividend and their debt. So they cut down their debt, and then in small roses ahead for this company. But yes, PGG Wrightson, we're going to have a look at the intrinsic value of PGG Wrightson. So this is the Graham's calculator. You can find this on Trade Brains. This is just a basic calculator to give you an idea of what possible intrinsic value of the company is. Using the share price, earnings per share, the growth rate, your predicted growth rate, so you can put whatever growth rate you want. The current bond yield will give you an intrinsic value. So we're going to look roughly just at the moment at $3.5 to stock at a 5% growth rate with the earnings per share of 0.23 gives you a value of $4.40, the intrinsic value. So at the moment it's not a bad price. Then if you add that up to 10% and you think it's going to grow, then you're looking at $6.08, or 80 cents, sorry, at 10% growth. Then if you go to, say they're going to double their earnings per share, 0.5, but more than double, then you're looking at a $14.90 stock. So is that realistic? Hell no. Will it ever happen? I doubt it as well. But this stock seems to be just one of those ones that pretty much doesn't do much. It's just more people buy it for the dividend, and it's mostly people on the inside that take it as part of getting stock when they work for the company. So I think that's more where that space is. But for me, where do I see the intrinsic value of this company? I'm looking lower. If you look at what the rates are and everything, you pay a dividend. I think you need to, if you want value for money, I think you need to get the stock at $3. If you get the stock at $3, if it somehow drops to $3, I think you're starting to get something worth buying, because then I think it'll go back up to about 4.5, maybe 5 if you're lucky. To see it go to 6.8, I don't see it in the near future. It's going to take a while unless they improve their growth rate somehow. If they absolutely smash it out of the park and their revenue goes to the $1 billion mark, which I'm sure that's going to happen, but they really need to jump it up to $2 billion somehow and get the net profit up to 30 to 50. Then we start talking about a company that can go easily up to 6, double your money. But yeah, at the moment it's stock I hold, and pretty much I hold it for the dividend. There's no doubt about it. If the dividend went away, it'll be see you later for PGG Wrightson more than likely. But that's not financial advice. Do your own research before you invest into any stock. Invest at your own risk. But hopefully that just gives you a little bit of insight into PGG Wrightson. Stock analysis were the key metrics, and then just giving you a possible intrinsic value, which then you can go do more research on to understand the company more and see if it's the right company for you. Well, if you liked the video, remember to like and subscribe to the channel. I'm very appreciative of all the people that watch this video, and so much, if you share it with all your friends, I'll be very much appreciated. Thank you so much for joining me, and have a great day out there, my friends.